Hey everyone, let's just dive right into this explainer because right now we need to objectively unpack what is honestly an unprecedented geopolitical and economic standoff. We're watching a situation unfold between the United States and Spain where military disagreements have literally spilled over into threats of a full-scale trade embargo. And this isn't happening in a vacuum. It's sending shockwaves through global markets and really testing the fundamental alliances of the Western world.
To really grasp the gravity of this situation, we have to start with this explosive directive from President Trump to his Treasury Secretary, Scott Bessent. So, following Spain's refusal to let the U.S. use its military bases for the war on Iran, the president demanded an absolute, immediate halt to all trade and dealings with Spain. He labeled them a terrible partner. This wasn't just some off-the-cuff political rhetoric. It was a direct, formal order to kick off the process of an economic embargo against a major, long-standing NATO ally.
Now, the response from Madrid was just as intense. Spanish Prime Minister Pedro Sanchez countered immediately, completely doubling down on his strict no-to-war stance. He publicly refused to be swayed by the threat of these economic reprisals and actually framed the Middle East conflict as playing Russian roulette with millions of lives. He stated unequivocally that Spain would not be complicit in a growing conflict just out of fear. So we have a very stark, unyielding line drawn in the sand here. So here's how we're going to break down this domino effect today. 1. A clash over war. 2. Can Trump actually stop trade? 3. The NATO spending dispute. 4. The billions at stake. And 5. The market fallout. Let's start with Section 1, a clash over war, and see how this geopolitical catalyst actually started. It's wild how rapidly this timeline cascaded. In March of 2026, Spain officially says no, the U.S. cannot access jointly operated bases in southern Spain for strikes against Iran. Then, fast forward just a few months to June, and Spain publicly rejects a new proposal demanding NATO members spend 5% of their GDP on defense. And that brings us right to July 2026. Boom. These military and defense disagreements instantly translate into the realm of total economic warfare with the order to halt all trade. Moving to Section 2, can Trump actually stop trade? Let's look at the legal reality. This is truly the multi-billion-dollar question, right? Does the executive branch actually possess the legal mechanism to unilaterally just sever ties with a European partner and NATO ally? Well, it all comes down to the IEEPA. This is the primary legal tool a U.S. president can use to block economic dealings. But there is a massive catch here. To invoke it, the president has to declare a national emergency and actually prove the target country poses an unusual or extraordinary threat to the United States. And legal scholars like Peter Shane over at NYU point out that it is really hard to see how a disagreement over NATO budgets and base access qualifies as a national emergency on par with historical targets for this act, like Iran or North Korea. Plus, you have to factor in the European reality. Leaders in Brussels are very quick to point out that under EU law, trade is handled as a single, unified bloc. The EU Internal Market Commissioner made it crystal clear. Any commercial threat against Spain is legally and practically viewed as a direct threat against the entire European Union. You literally cannot economically isolate Spain without taking on the rest of Europe. But, okay, let's say a full unilateral embargo fails those legal tests. The president still has a whole toolkit of other retaliatory steps. He can leverage Section 232 to impose tariffs based on national security, use Section 301 to penalize actions deemed burdensome to U.S. commerce, or rely on anti-dumping rules. And we've actually seen this playbook before. A previous anti-dumping tariff on Spanish black olives absolutely tanked their U.S. market share, dropping it from 49% down to just 19%. So make no mistake, the economic threat is very real, even if a total embargo is legally complicated. Okay, Section 3, the NATO spending dispute. Here is the defense reality. At the very core of this defense argument, you have two totally different perspectives. On one side, the U.S. administration is firmly demanding that NATO allies contribute 5% of their GDP to defense. But on the flip side, you have Spain's current reality. Spain says they are fully on track to hit the traditional 2% NATO target by 2026, which is a massive €35.41 billion budget. Madrid also points out they are NATO's 7th largest absolute spender and the 3rd largest contributor of troops to international missions. So they're basically arguing, hey, our contribution is already huge, while Washington argues it's mathematically falling short. Which brings us to Section 4, the billions at stake, the economic reality. What you absolutely need to take away from this is the sheer scale of this relationship. We are talking about a combined $74.5 billion in goods and services traded in 2025 alone. And interestingly, the U.S. actually runs a $3.96 billion trade surplus with Spain. Think about what that means. An embargo wouldn't just hurt Spanish businesses, it would immediately wipe out nearly $40 billion of revenue for American exporters. Digging a little deeper into that export data, we can see exactly what American businesses are selling to Spain. Industrial supplies at nearly 30% and consumer goods at over 16%. That's the lion's share. We're talking about chemicals, plastics, electronics, and clothing that are manufactured in the U.S. and sold right to Spanish consumers and businesses. Now, conversely, when we look at imports, what the U.S. buys from Spain, it's super fascinating. American travel and tourism makes up the single largest slice of the pie here. Nearly 20%, representing $6.82 billion, is literally just Americans traveling to Spain. It really highlights how deeply interconnected these economies are. It goes way beyond just shipping physical crates of goods back and forth across the ocean. Finally, Section 5, the market fallout and the immediate impact. Almost the second these trade halt orders hit the wire, Spain's IBEX 35 stock index plunged 2.6%. That was its worst one-day fall since the initial threats back in March, making it the worst-performing major European stock market index that entire day. And that financial pain, it was distributed across massive, global players that we all recognize. You've got banking giants like Banco Santander and BBVA taking huge hits, alongside retail behemoth Inditex, they own Zara, by the way, and telecom leader Telefonica. It's a perfect example of how global markets price in geopolitical threats instantly, erasing billions in market value before the ink is even dry. And the panic definitely wasn't limited just to stocks. As part of a broader global sell-off, yields on Spain's benchmark 10-year government bond surged by 9 basis points to 3.565%. Now, because bond yields rise when prices fall, this basically tells us investors are suddenly demanding much higher returns just to hold Spanish debt. It created the highest borrowing premium over German bonds this month, making it literally more expensive for the Spanish government to fund its own operations. On top of that, Spanish 5-year credit default swaps spiked to a 1-month high of 15.6 basis points. If you're not familiar, a credit default swap is essentially an insurance policy against a country defaulting on its debt. So when that number shoots up, it means the broader financial system is actively calculating a significantly higher risk of economic instability in Spain because of the standoff. So I want to leave you with this final fact for today's explainer. We have just seen how a military disagreement regarding the Middle East can rapidly, almost overnight, evolve into a threat against a $74 billion economic ecosystem. As these political battle lines harden, supply chains are threatened, and markets tremble, the fundamental architecture of Western alliances is facing its most severe test yet. So is this a temporary diplomatic rupture, or are we looking at the new permanent reality of global trade? Thanks so much for joining me to unpack this, and keep learning.